Have you noticed a stock that just keeps climbing, defying market trends and consistently reaching new heights? It's the kind of performance that makes you sit up and take notice, wondering what's driving such impressive growth. Grabbing everyone's attention, from seasoned investors to those just starting out in the stock market, the buzz is palpable, and the questions are swirling. Is this a flash in the pan? Or is there something more substantial behind this remarkable ascent? Today we're talking about Gravita India, a company that has been quietly but steadily making waves in the market. This company has delivered stellar returns, outperforming many of its peers and capturing the imagination of investors seeking high-growth opportunities. Making early investors very happy, as their initial investments have multiplied significantly over a relatively short period. The kind of returns that can transform portfolios and fuel financial dreams. Gravita's rally isn't a fluke. It's not just a lucky streak or a temporary surge. It's rooted in a bigger story about sustainability, global demand for recycled materials, and a smart, well-executed business strategy that positions the company for long-term success. When a stock multiplies several times in just a few years, generating exponential returns for its shareholders, it's natural to be curious and want to understand the underlying factors driving such impressive growth. It's time to ask, what's fueling this run? What are the key drivers behind Gravita's success? And can this momentum be sustained in the long run? It's a mix of strong financial performance, consistently exceeding expectations and delivering solid results quarter after quarter. A compelling business model that is both innovative and scalable, allowing the company to capitalize on emerging opportunities in the recycling sector, and being in the right industry at the right time, perfectly positioned to benefit from the growing global focus on sustainability and resource efficiency. The world is waking up to recycling and the circular economy, recognizing the urgent need to reduce waste, conserve resources, and create a more sustainable future. And Gravita is perfectly positioned to ride this wave, leveraging its expertise and infrastructure to meet the increasing demand for recycled materials. The company isn't just local. It has a global footprint, with operations spanning multiple continents and serving a diverse range of customers. Adding diversification and growth potential, reducing its reliance on any single market and opening up new avenues for expansion and revenue generation. This is about turning waste into wealth on a global scale, transforming discarded materials into valuable resources that can be used to create new products and drive economic growth. Gravita operates in lead, recycling and refining this critical metal for various industrial applications. Aluminum, processing scrap metal into high-quality aluminum products, and plastic recycling, addressing the growing problem of plastic waste and transforming it into valuable raw materials. Critical for batteries, construction, and more, providing essential materials for a wide range of industries and applications. With the shift to electric vehicles and rising energy storage needs, the demand for batteries is soaring, creating a huge opportunity for companies involved in battery recycling. Demand for recycling is booming, driven by environmental concerns, government regulations, and the increasing cost of raw materials. Companies like Gravita create a sustainable loop, minimizing environmental impact and promoting a circular economy where resources are reused and recycled. Reducing waste and conserving resources, helping to protect our planet and ensure a more sustainable future for generations to come. This strong ESG angle makes Gravita attractive to investors who are increasingly focused on environmental, social, and governance factors when making investment decisions. Who want growth and a positive impact, seeking companies that not only deliver financial returns but also contribute to a better world. In this analysis, we'll break down Gravita's business, financials, and high valuation, providing you with a comprehensive overview of the company's performance and potential. We'll also look at its expansion plans, management team, and the potential risks you need to know, giving you a balanced perspective on the opportunities and challenges facing the company. My goal? Give you a 360-degree view so you can make informed decisions, empowering you to assess whether Gravita India is the right investment for your portfolio. Let's dive into the world of Gravita India and explore the factors driving its success in the dynamic and rapidly growing recycling industry. A look inside the recycling powerhouse. So let's get down to the basics. When we talk about Gravita India, what exactly is their core business? What drives their operations and sets them apart in the industrial landscape? In simple terms, Gravita is a recycling company, but that simple definition belies a complex and crucial role they play in the global economy. They're not just processing waste, they're transforming it. But it's not just about collecting old newspapers and bottles from your curb. That's a small piece of the recycling puzzle. Gravita specializes in recycling lead, aluminum, and plastics, the heavy hitters of the industrial recycling world. These are materials essential to countless industries, and Gravita is at the forefront of recovering and repurposing them. Its main revenue driver is lead recycling. This is where Gravita truly shines, possessing the expertise and infrastructure to handle this complex and vital process. Gravita collects used lead-acid batteries, a massive source of recyclable lead. Think about all the batteries powering our lives, like those from cars, backup power systems, and telecom towers. When these batteries reach the end of their life, Gravita steps in. They extract pure lead and alloys through advanced processes, employing cutting-edge technology to maximize resource recovery and minimize environmental impact. It's a sophisticated operation. This recycled lead is then sold back to battery manufacturers for use in new batteries, closing the loop and reducing the need for newly mined lead. It's a classic circular economy model in action. Waste becomes a valuable raw material, ready to be used by another industry, reducing reliance on virgin resources and promoting sustainability. Recycling lead uses up to 60% less energy than mining new lead. That's a significant energy saving, contributing to a lower carbon footprint. And it prevents toxic waste from polluting land and water, safeguarding our environment and protecting public health. This is a critical benefit of responsible recycling. Gravita has invested heavily in building eco-friendly recycling plants to master this process, ensuring that their operations adhere to the highest environmental standards. Beyond lead, the company also recycles aluminum scrap, transforming it into high-quality alloys used in automotive and die-casting industries. They also process plastic waste, converting it into flakes and granules, ready to be used in the production of new plastic products. These recycled plastics find their way into packaging materials and even textiles, demonstrating the versatility of recycled materials. This diversification reduces the company's dependence on a single commodity, making it more resilient to market fluctuations and economic downturns. Gravita's business model stands out not only for its commitment to recycling, but also for its global reach and integrated approach to resource management. The company operates in over 15 countries, spanning multiple continents and diverse markets. Their operations extend across Asia, Africa, and Central America, allowing them to tap into different sources of scrap materials and serve a wide range of customers. This global presence allows Gravita to strategically source scrap where it's most economically advantageous, optimizing their supply chain and reducing costs. And they can efficiently sell their recycled products where demand is highest, maximizing their profitability and market reach. Such a geographically diverse network insulates the company from regional economic downturns and regulatory changes, providing a buffer against unforeseen challenges. Gravita has meticulously built a strong and reliable supply chain for collecting scrap materials, ensuring a consistent flow of resources for their recycling operations. They've also cultivated a reliable customer base for their recycled products, establishing long-term partnerships and ensuring a steady demand for their output. The company operates in a niche, high-growth sector, perfectly positioned to capitalize on the increasing demand for recycled materials. Demand for its products is fundamentally driven by both industrial growth and the increasing global focus on sustainability trends. As industries expand and environmental awareness grows, the need for recycled materials will only intensify. Lead is an essential component for batteries, which are crucial for energy storage and powering a wide range of devices and vehicles. Similarly, aluminum is vital for lightweight vehicles, reducing fuel consumption, and for construction, providing durable and sustainable building materials. The global push for sustainability and the implementation of stricter environmental regulations are creating a massive tailwind for the recycling industry as a whole. This growing emphasis on environmental responsibility is a massive tailwind for the recycling sector, creating significant opportunities for companies like Gravita. Companies across all sectors are under increasing pressure to use recycled materials in their products and processes to reduce their carbon footprint and meet sustainability goals. Gravita provides a green and economically viable solution for these companies, helping them achieve their sustainability targets while maintaining profitability. It's a business model that's not only profitable in the present, but also future-proof, designed to thrive in a world increasingly focused on sustainability and resource efficiency. And that's precisely why Gravita is turning heads in the industry and attracting the attention of investors who recognize the potential of sustainable and responsible business practices. Let's talk numbers, because numbers reveal the real story. They provide an objective view, stripping away the hype and showing us the true health and potential of a company. We're going to dive deep into Gravita's financial performance, examining key indicators that paint a clear picture of its success. Gravita's financials show impressive growth. We're not just talking about incremental gains, we're seeing substantial leaps that demonstrate a company on the move. In FY21, revenue was about Rs 597 crores. This figure serves as our baseline, the starting point from which we can measure the company's subsequent progress. By FY24, it surged to over Rs 180 crores. This isn't just a slight increase, it's a dramatic climb, showcasing the company's ability to significantly expand its revenue streams. Doubling in just 3 years, such rapid growth is a testament to Gravita's effective strategies and its ability to capitalize on market opportunities. This rapid expansion signals strong demand and market share gains. It indicates that Gravita is not only attracting customers but also solidifying its position within the industry. The company is clearly doing something right to achieve this level of growth. But what about profits? Revenue growth is important, but it's equally crucial to examine whether that growth is translating into increased profitability. In FY21, profit after tax was around Rs 76 crores. This is the amount of profit the company retained after accounting for all expenses and taxes. By FY24, it jumped to Rs 228 crores. This substantial increase in profit demonstrates that Gravita is not only growing its revenue, but also becoming more efficient at converting that revenue into profit. Profitability is growing even faster than revenue. This is a key indicator of a healthy and well-managed company. It suggests that Gravita is improving its operational efficiency and cost control measures. A sign of operational efficiency. The company is streamlining its processes, reducing waste, and maximizing output, all of which contribute to higher profit margins. Gravita manages costs well and benefits from firm prices for its products. This combination of effective cost management and stable pricing allows the company to maintain healthy profit margins, even in challenging economic conditions. This strong bottom-line growth drives shareholder value and supports a higher stock price. Investors are attracted to companies that demonstrate consistent profitability and growth potential, which in turn drives up demand for the stock. Another key metric, return on capital employed, ROCE. ROCE is a crucial measure of how effectively a company is using its capital to generate profits. Gravita's ROCE has consistently been above 20 to 25% in recent years. This is a very strong performance, indicating that the company is generating significant returns on its investments. That's a sign of skilled capital allocation and high efficiency. It means Gravita is making smart decisions about where to invest its resources, and it's operating its business in a highly efficient manner. For every Rs 100 invested, Gravita generates over Rs 25 in profit before interest and tax. This impressive return highlights the company's ability to generate substantial profits from its investments. This efficiency is why investors pay a premium for the stock. They recognize the value of a company that can consistently generate high returns on capital, and they are willing to pay a higher price for the opportunity to own a piece of that business. The company isn't just growing, it's growing profitably and sustainably. This is a crucial distinction. Sustainable growth means that the company is not sacrificing long-term stability for short-term gains. Now let's check the balance sheet. The balance sheet provides a snapshot of the company's assets, liabilities, and equity at a specific point in time. Gravita has managed debt prudently, keeping its debt-to-equity ratio below 1. This is a conservative approach to debt management, indicating that the company is not overly reliant on borrowing to finance its growth. This means the company isn't over-leveraged and has a healthy financial structure. A healthy financial structure provides a solid foundation for future growth and allows the company to weather economic storms. Management plans to fund future growth through a mix of profits and debt, keeping the balance sheet strong. This balanced approach to funding ensures that the company can continue to grow without taking on excessive risk. A solid balance sheet gives Gravita resilience in downturns and flexibility for new opportunities. With a strong financial foundation, Gravita is well positioned to seize new opportunities and expand its business in the years to come. The numbers show Gravita is not just a growth story, it's a financially sound one. This is a critical distinction for investors, as it provides assurance that the company's growth is built on a solid foundation. That's what makes it stand out in the market. In a crowded marketplace, Gravita's financial strength and sustainable growth set it apart from its competitors. Let's see if the stock price matches the fundamentals. Does the market valuation reflect the underlying strength and potential of Gravita's business? That's what we'll explore next. After such a run, is Gravita's stock too expensive? Let's look at its valuation. As of mid-2025, Gravita trades at a PE ratio much higher than its historical average. For example, it might be at 35, 40 compared to 10, 15 a few years ago. A high PE means investors expect strong future growth, classic growth stock territory. Compared to traditional metal companies trading at PEs of 10, 12, Gravita's valuation looks steep. But Gravita isn't just a metal company. It's a high-growth, ESG-focused recycler with global reach. Investors pay a premium for its unique model, growth, and environmental impact. Compared to other high-growth specialty chemical companies, Gravita's valuation seems more reasonable. Analysts are split. Some say the high valuation is justified by future growth and expansion into new geographies and recycling verticals. They believe earnings will grow fast enough to bring the PE down over time. Others warn the stock price already factors in all the good news. At this valuation, there's little room for error. Any negative surprise could trigger a sharp correction. Some advise waiting for a better entry point, perhaps during a market dip. Both sides have valid points. The right answer depends on your investment horizon and risk tolerance. If you believe in Gravita's long-term story, the premium might be worth it. If you're cautious, patience could pay off. Let's weigh the risks and opportunities. High valuations are a double-edged sword: opportunity and risk. On one hand, a high valuation signals market confidence in the company's quality and growth. For Gravita, the premium reflects belief in recycling, sustainability, and global expansion. Buying at a high valuation can be rewarding if the company keeps delivering, but high expectations mean higher risk. At a PE of 40, the market is paying for years of future growth. The company must consistently meet or beat expectations. Any disappointment, missed earnings, delays, or cautious guidance can cause a sharp drop. The margin of safety is thin. You're betting on future growth to justify today's price. If the story falters, recovery could take years. Value investors are often wary of such stocks. So, how should you approach this? Focus on business fundamentals and future growth drivers, not just valuation multiples. Ask, is the growth story credible? Does Gravita have a durable advantage and capable management? If yes, paying a premium may be justified for long-term investors. Still, manage your risk, consider investing in tranches or using a SIP approach to average your cost. This way, you can participate in the upside while protecting against sharp corrections. Ultimately, it's about balancing conviction with caution.